Hi, this is Hyperwave. I'm Leah Wald here with Tyler Jenks, and this is going to be a fun one. We're going to talk about the craziness in the US stock markets and also how the ramifications for international markets, as well as, of course, Bitcoin. So we'll try to make this one a little quick. Obviously, the market's just closed here, which is why we wanted to go live quickly. And so with that said, straight over to Tyler today. Go, Ty.
Great. Thank you very much, Leah. Interesting day today, interesting 2 weeks and 4 weeks. We're going to just look at a lot of charts, and we're going to do it from a Consensio point of view because so many people listened to the Consensio conference webinar that we had, and it applies perfectly to our current situation. Just in brief, we've had a number of individual stocks break down from hyperwaves. We've had several sectors break down very strongly, including indexes coming very close to breaking down into bear market-like activity. But we will look at each one of them, and I will give you a couple of little clues about Consensio that we weren't able to talk about before that I think will be helpful. So what we're going to do is we will move to our nemesis trading view, and we will pull it up, and then we will make it big, and we will start with the indexes. And we will start with the best indexes, the smallest, and we will move through a number of the other ones. So what we are looking at is, I think what I'll do is I'll make that big. And this is the Dow Jones Industrial Average. There are 30 stocks in this average. This average, as of 5 weeks ago, was in a booming bull market with the price above the short-term moving average, above the intermediate-term average, and the long-term average, and all three averages moving up. That's a definition of a bull market. Starting 4 weeks ago, it was called into question short-term because price dropped through the short-term. The next week, price dropped through the short-term and the intermediate-term, and the short-term dropped through the intermediate-term, and the intermediate-term turned down. 3 weeks ago, 2.5 weeks ago, we penetrated the long-term moving average with this wick. We stayed slightly above it last week because of the big 580-point up day we had. But then early this morning, we broke down through it sharply. We have come back at the close to close above the long-term moving average. This is very important. And the wick is longer than the body, and the body is above the wick. And you will see that over and over again when we look at things today. What does this all mean? From a Consensio point of view, taking the name off, and even if we were to take the price off, which we won't do because we don't have time for a bunch of that, but just do it mentally. We don't know what we're looking at. I would raise 5% when the short term dropped through the intermediate term, and I would raise another 5% when the intermediate term turned down. So I would be 10% in cash, not knowing what this thing was. So if I had X in whatever this thing was, I would have started raising a little bit of cash, but not very much. 10%, I'm still 90% invested. Now, when we put the price back on, something very important happened with this 2.5 weeks ago, because the price dropped not only through the short term and the intermediate term, but the intermediate term turned down, and we actually broke the long-term moving average on price, but at the end of the week came back above it. So on that action, the price action, I would raise another 5%. So that's 15%. And on the price action today, even though we're not at the end of the week, because we broke through the long-term moving average and the short-term is coming down so quickly, I would have taken another 10% off, which I did today in my discretionary account. So I am 25% in cash, and we are still sitting at 25,000 on the Dow, which is where we were back here and through all of these periods. But now I am 25% in cash on this particular index. All right, let's take a look at a bigger index, the S&P 500. The S&P 500 looks worse than the Dow, but not by much. The difference between these two charts, there's the Dow and here's the S&P 500, is the fact that this entire body is below, the body of the candle is below the long-term moving average. That's not what we saw on the Dow. On the Dow, we saw a penetration, but then today, by the close, we were back above the long-term moving average. The S&P has a long tail, and it did a nice reversal, but it is still below that long-term moving average on a daily basis, as it was last week in terms of the price below it. Now, that has not turned the long-term moving average down. And this has all happened within basically a 3-week period out of a bull market. So that is very significant. We'll see why when we look at the some of the other indexes. But based on this, I would be a full 25% cash in the S&P as of last week. Now, it is true that we broke below the long-term moving average on price the week before, but the fact that this was a green doji and the short-term had not yet broken through the long-term, I would not have put the full 25% on. I would be looking to do another 25% in the S&P if this intermediate term comes down to the long term and price stays below the long term, because that means we're going to turn the long term down. We have not done that at this point, so I haven't taken any additional move on the S&P 500. This is the Nasdaq 100, and something very interesting is happening between this one, the 100 biggest stocks in the Nasdaq, and this one, which is the Nasdaq Composite. The Nasdaq Composite technically is worse off than the Nasdaq 100. And that's hard to understand because a number of the Nasdaq 100 stocks have broken down big time. And they are included in both of those indexes. But you can see that on the Nasdaq itself, both of these closing candles are just slightly below the long-term moving average, and the long-term moving average is in no danger of turning down. So this action, these three candles, the wicks on these three candles look like they want to break back up through the long-term moving average. And it's all happened so quickly that the intermediate term hasn't had a chance to catch up with the price. That's important because that could be setting up for a reversal back to the upside. On the Nasdaq Composite, it's going to be difficult because the intermediate is coming down so quickly and price is so far below the long-term moving average that I can't give it the benefit of the doubt, even though it's attempting to hold here today. And we'll see what happens tomorrow. But tomorrow and the rest of the week are going to be very, very important in order for this not to become a very negative situation on the Nasdaq Composite. I would be 25% out of the Nasdaq, looking to add another 25%, depending on what happens over the next 3 days and into next week. This is a long way at 7,400 on the closing basis, 7,437, back to this 7,600 long-term moving average. This thing has got to get going very quickly. I'm going to tell you why I think it might when we get through these and then the sectors. Here's the Dow Jones Transportation Index, and this is very nasty. It's nasty from the point of view that just 5 weeks ago, we hit all new time highs on the transports, which meant that the Dow Jones Transportation Index confirmed the Dow Industrials that we just looked at in a Dow theory buy signal. And here, in just a very short period of time, we have gone to new lows on a closing basis today. And unless we get going, we will close below the previous closing lows from back in July, late June and early July. That's important because now we have lows below lows. And look at the speed with which the intermediate term is coming down to the long term. The long term has not turned down yet. It's flat because of all this activity above the long term, and particularly this long term activity. But it won't take long if the intermediate term breaks down through it to give to turn the long term down and be in a full bear market in the Dow Jones Transportation Index. And finally, the Russell 2000 small cap. Consensus doesn't get any worse than this on an index. And it happened just as quickly as we saw it on the Nasdaq. And we have the intermediate term below the long term. The long term is still moving up, but notice what we are looking at here. We're looking at price below the short term, below the intermediate term, which is moving down. And now it won't take very much before the long term to turn down, and we are in a full bearish posture. I would be 50% out of Nasdaq, or excuse me, small cap stocks, the Russell 2000 kind of stocks at this point because of the devastation of these two candles. All right, now I'm going to switch over to the sectors, and we're going to go through those quickly because we want to see where is the strength and the weakness in things like the Dow and the S&P 500. And so if we start with consumer goods, which is basically consumer discretionary, we can see that all three of the moving averages are moving down. Now, this one has been moving down all the way since the beginning of the year, which means if we go back, you'll see that the price turned down very sharply back here in the end of December going into January, broke all the way through and turned the long-term moving average down. It's been moving down ever since. Based on that, you shouldn't be in this other than its position in already existing indexes. But you shouldn't have money specifically in this territory, even though we ran back up all the way back up to the long-term moving average, broke through it, and looked like we were going to try to reestablish along with all the other indexes and the other sectors. We did not. We fell apart. And so this is a 100% out of this because price is below all the moving averages. All the moving averages are moving down, and the intermediate is below the long term. That's the definition of a bear market. Let's take a quick look at the consumer services or consumer staples. as they're called, and the long term is moving up very nicely. Just 3 weeks ago, everything was in a bull market. It ended on this candle, and we would be 15% in cash in this. Had a very nice turnaround. We did 3 weeks ago. We had a full candle doji above the long-term moving average, and now we're closing above slightly the close of last week, even though we were much further down below it. So this is setting up to keep the intermediate term from getting very close to the long term, but we need a pretty big spike. So we would be a total of 15% in cash out of this, but this would be a place to hide for those looking for a place to hide on a sector level. This is the energy, and energy back here was in a full bull market. It then stalled, came back and tested the long-term moving average, which then held for 4 weeks in a row, and then we were able to move up very sharply before the last 3 weeks. Now notice that the long-term moving average and the price action going into late last year was very negative, and energy was the worst performing sector. Based on that, I got into energy when we broke through the long-term moving averages, and particularly earlier this year on the first correction in the big Dow S&P kind of indexes, when we were able to reestablish ourselves in an uptrend in another bull market with a high above the high. So this is very disappointing for me that this last high wasn't able to take out this high, and we've dropped all the way back down through it. And notice this action right here. All three moving averages ripping each other apart and going through the long term, which because of this action is still moving up. I would be 50% out of energy based on this action and in cash. Let's take a quick look at the financials, which had been doing very well until these highs could not take out these highs, and we had a spike in interest rates from 3% on the 10-year up to 3.28. Those have eased, which has helped a little bit, but that hasn't helped the financials at all. All this activity is below the long-term moving average, which has turned down. And even though we tried to bounce, nothing like we've seen in the other sectors. So the financials are in trouble again. And this is a full bear market with the long term now moving down and all the others in line to go lower. So we would be out of the financials based on Consensio. The healthcare is attempting to give us some strength along with what we saw in the consumer staples. And right now we would have only 15% out of healthcare. Very difficult for the intermediate term to come down through the long term because of all this positive action. Healthcare is a place to hide. This is the industrial sector. We had highs above the previous highs slightly. We were looking very good bull market activity, and in a 4-week period of time, it's all reversed. Now all the price activity is below the long-term moving average. The intermediate has not yet cut down through it, but we would be, because of the price action, 50% out. And all of these numbers I'm giving you are based on each increment as you go down. I'm not just throwing these out because we're where we are now. That's the way Consensio works. It's step by step. And notice that it won't take long before we're 100% out of these things. And we're still at the highs of this very, very long bull market. That's what you've got to understand about Consensio, is you have to be ready to do whatever it says, so that if a bear market in the entire stock market is starting, you are starting with a tremendous amount of cash, and very early in the process, you are out of danger. Okay, these are the utilities, which is the other area that you can be hiding in. because we've got price above all the moving averages. This is the best looking of all the sectors. And the long term has moved up sharply because of all this activity. So even though these moving averages are getting fairly close to each other, this is in a full bull mode at this point. And even though we tried to come down today and we closed negative for the day, would not surprise me if on the next bounce we take out the all-time highs on this utilities. And the last one I want to look at is the telecommunications. Very surprising, because telecommunications have, as an industry and as a sector, have been in a bear market for a long time and just broke out of it in early August and went from a bear market into a bull market with price ahead of everything. And so this recent break has not taken out the long-term moving average, which is moving up. And I would only be 15% cash in telecommunications. That might be another place to hide. Now, I'm going to look at one other thing very quickly, because so many people have been asking about it. And these are the short funds. These are short ETFs that have been going up for a long time, meaning the underlying Nasdaq has been going up for a long time. And now what's happened is, while everything else is breaking down, these are breaking up and will not take too much more of a move to get all the moving averages and the price above the long-term moving average. If we look at the pro shares, just the S&P, you see it is doing just the opposite that the S&P is doing. Where the S&P was correcting down through the long-term moving average, this was correcting from a down to an up. Then as the stock market started moving up again, this began moving down again. And you can see again, it is establishing itself, attempting to get itself, meaning an inverse of the S&P, in a long position. That's how you can use these instead of using Consensio to simply raise cash. You can keep all your positions and use some cash in order to put on these positions that run inversely to the indexes. Here's the MYYs, which is the mid-cap short. And you can see it's already broken out, and it is already in a bull market because price is above short term. Short term is moving up. Intermediate term is now broken above long term. And this action means that the long term, even though you can't see it, it looks flat, is slightly turning up and soon will be accelerating up unless the stock market, the mid cap, begins to move up. Here's the dogs. This is the Dow 30. And the Dow 30, just as its inverse would imply, is coming up, testing the long term, just as the price is testing the long term from the other direction. This is a good way to hedge if you don't, for tax reasons, and you're not using retirement accounts. This is a good way to be able to protect your account by using these against positions you either haven't gotten out of or are reluctant to get out of for whatever reason you've got. This is the Russell 2000 inverse, the RWMs, and you can see here that we have done the same thing as we've done on the mid caps, broken through the long term. Intermediate is broken through the long term. It will just be a matter of days or short hours before the long term moves up, and this is in a fully bullish configuration. What I'm saying is this is not lending me a lot of optimism about the overall market. When you get the short inverse funds acting like this is the small cap 600, which is doing the same as the Russell 2000 and the mid caps are doing. And you can see the intermediate here has not yet broken through the long term. But I just wanted to give you those symbols. These are ones that I use, the PSQ, the SHs, the MYYs, the DOGs, the RWMs, and the SBBs. You can also do the same thing with mutual funds. These are ETFs. Their advantage is they trade all day long. Okay, so I told Leah that we would get all that in 30 minutes, and we've just hit that. And that gives us a little room to take some questions. But before I do that, what I want to do is get out of screen share, and I want to make this big and just reiterate what I said with Leah on our vlog on Saturday, which was there is no, at this point, economic reason for the stock market to begin a bear market. There are some indicators that people are worried about, but it is not the GDP, it is not corporate profits, it's not employment, it's not wage growth, and it's not confidence at the consumer level or at the corporate level. Therefore, a bear market should not be starting. The only thing that I have been talking about is a political question, and I still believe everything that I said in that blog if you want to go back and look at the one that we did on Saturday. As you see, we've gotten a lot more adept at using trading views since Saturday. Okay, with that, I'm going to turn this back over to Leah and see if we've got time for a couple of questions.
We do. Good job, Ty. We have some really great questions. And then, yes, at the end, guys, we would like to talk a little bit about, if possible, our next webinar coming up, which, to Tyler's point, is chock full of really interesting things. Okay, let's start you off. So, number one, is the total U.S. stock market hyperwave, quote unquote, more important, end quote, than its constituent hyperwaves, given that investors should have the bulk of their portfolio in broad indexes?
Well, the total, if the total U.S. stock market was in a hyperwave, we have not broken down that hyperwave. And I say if because it's very difficult to define what you mean by the whole U.S. stock market. There's a thing called the total market index and something that used to be the Wilshire 5000, which is now the Wilshire 4500. But there's actually close to 9,500 different stocks. And so it's difficult. It's much easier to look at each individual index as its own separate formation, rather than trying to put them all into one. And in that, we have only, in my estimation, we have not broken down on any of them, including the Nasdaq or the Nasdaq 100. We are close. And if these sectors and individual indices break down below the Consensio long-term moving averages, we run the risk of the Nasdaq 100, the Russell 2000, breaking out of hyperwaves to the downside. Now, what I don't know, and nobody knows because we haven't seen this since 1929, and then again in 2000, and then again in 2006, significant bear markets, but we were not in a hyperwave on all the indexes in 1998, 99, and 2000. That was localized to very few stocks that happened to be very big stocks in the technology sector. And that was clearly in a hyperwave, and the Nasdaq was in a hyperwave, and we've shown you that chart and what happened after that. So if the entire market, the Wilshire 5000, was in a hyperwave, then that would take precedence over all of the individual indices, which most of them must also be in a hyperwave by definition. If one index is in a hyperwave and it breaks down into its fifth phase, That doesn't mean that all the sectors of the stock market are going to be doing the same thing as that index. That's why we looked at the sectors. If 6 or 7 of the 10 or now 12 sectors are positive and not in hyperwaves, and you've got one index that's breaking down, that becomes an important configuration. And then finally, you want to look at the industries where the weakness is happening. Then you want to look at the individual stocks. So don't ever just isolate one thing and draw a conclusion that we are headed down to much, much lower levels in a bear market. Take it a step at a time. We will try to keep you up to date through our vlogs as well as through our webinars, and particularly the one coming up. I want to spend a good couple of minutes talking about that at the very end. But so that's my answer to that question.
Thanks, Ty. When are you fully out of an asset if you always take a percentage off the asset? If it is always a percentage, how can you be fully out? Which point triggers a 100% transfer to cash?
I'll just give you an example. Everybody's got, this is not advice on how to raise cash relative to Consensio, but I will give you an example of numbers that I have used in the past. There's 6 numbers, 5, 5, 5, 10, 25, and 50. If you add those up, that's 100. And what it means is that each one of the 6 crossing points that I talked about today, and we talked about in great detail in the Consensio webinar, you take those numbers off in order. The first crossing is 5%, then another 5%. Not 5% of what you had, 5% of everything that is left, including the fact that you've got that 5% in cash. So you go from 5 to another 5, that's 10% of your total portfolio. Then another 5 is 15%. Then another 10 is 25%. That's why I was throwing out those 25% numbers. That's after 4 moves. After 4 moves, a quarter of your money is in cash. After the 5th move, you do a 25%. Now you've got 50% in cash. And after the 6th move, you are at 0. You are completely out of the market.
I know, I was muted. I was the one muted this time.
Yay! Touchdown.
You're on a roll. By the way, by the dip. Cryptic Stoic is the coolest, guys. Okay. There's really, really good questions today, by the way. Thank you.
They are. Great.
Yeah, you're going to want to take all of them. I will promise. Maybe
we don't have time because Leah's got a hard close at 4:45. So we'll take a couple more, but we will have all of these questions and we will get to them in our next vlog, which will probably be tomorrow. We're going to try to do a vlog every day now because we are in this very critical period between now and the election.
Well, then let's continue on that one. So with the United States, with the US midterm elections and earnings coming up, well, we're in earnings, but more, what needs to happen for a positive scenario and for a negative one? What are some key dates and things that we should look at?
Well, you don't have to worry about earnings. Earnings are going to come in nice and strong. Not the 22% we saw for all of last year, but all of 2018 earnings are positive and they could be up, in the 17, 18% range. So yeah, this stock, that stock might miss, but not the US stock market. Don't consider that as part of the equation. The only thing we're talking about here is the election. And with the election, the only thing we're talking about is, will the Republicans hold the House or not? And if they don't, what does that mean? And to me, it means that there's a lot of confusion between now and Election Day as we get closer and closer. And it looks like the Democrats can take enough House seats to take control of the House. That will change the picture. But for me, that doesn't become a bear market. That means that we have stalemate in Washington for the next 2 years. We'll have impeachment going on. and it'll be difficult for any new policies to get passed. In a stalemate, what the economy and the stock market run on is the strength of the economy, which is very, very strong and will continue to be very strong after the election. So that does not warrant a bear market. Now, here's the other side of that equation, in my opinion. If we don't get stalemate in Washington and the Republicans keep control of the House so we don't have to play for 2 years with the impeachment process, then Trump will be in a stronger position to do more things for the economy. And let's not argue the politics of it. Let's argue what the stock market and the economy has done since he has taken over. That's it. That's what the business community is focused on. And that's what the stock market is focused on. Therefore, if the Republicans keep the House, and I believe pick up a couple of seats in the Senate, we are in for a very big bull market explosion in November and December and through most of next year.
Thanks, Ty. There's two really good questions. One is here, one I'm going to ask for myself. So since I'm selfish, I'm going to do myself first, and then hopefully this last one, and then we'll finish. Yes, because everybody, we need to talk a little bit about Bitcoin. So only with that said, Tyler, what are your thoughts on the fact that the BACT finally released that their futures are going to officially happen in December?
Yeah, I think it's important that Bitcoin did not respond in any way to that announcement. And that's on December the 12th, the futures contracts in Bitcoin will be open for trading, and the size limit is 1 Bitcoin, which is pretty interesting. I think that's a huge step forward for Bitcoin, and there was no response to it. And I wouldn't have expected a response to it, because putting something on an exchange does not mean that everybody is not going to use that exchange to sell the heck out of whatever it is. It is not a directional play. It just means there's a new playing area for those when they get bullish to be able to buy, and for those when they get bearish to be able to sell easily. That's all it does. And it's regulated, and it's regulated in such a way that now I am happy and I will buy Bitcoin through the futures market on this new backed exchange on the ICE. Now, I'm not going to do it now because I'm a seller of Bitcoin. Will I short the way Tone did? No, because I've already told everybody I will never short Bitcoin. And not because I don't think I can tell when's the right time to short it, because I don't know when something can happen that will cause Bitcoin to go up to $20,000 tomorrow morning. And that would be a macroeconomic event, and Bitcoin has that potential. So I would never short it. I will short all of the other cryptos all the time because they're not going anywhere except for down. Okay, so that's my response to the backtape. Also, if you want a great discussion of this, listen to Tone and Van Zen and Willie Woo. They had a 2-hour vlog that was fascinating today. In it, they talked about the exchange, and I think they had a lot more time than I did to make it very clear. But I would fully encourage everybody to listen to that if you haven't already.
Thanks, Ty. Last question. Okay, cool. So I think this is a really interesting question. I started live chatter. I don't remember which person asked this, but I really, really like it. I'm going to tweak it a little tiny bit if that's okay. Given that we have earnings coming out, my favorite word when I first entered finance was learning about bellwether stocks and how they affect the economy. So I will read this question directly and maybe add a little bit to it. What are the odds of a hyperwave on a specific stock failing early due to an overall market turning?
Yeah, it's a great question. And I have not seen that. because what tends to happen is when the market begins to fail is when stocks go into hyperwaves. The fifth, sixth, and seventh part of the hyperwave, that's where they fail. What you're asking really is, what if you're starting, you've gone from a phase one to a phase two, to a phase three? My answer would be you've got a 15% probability that in a bear market, something in a phase three of a hyperwave will turn down and break that. Because 85% of the time when you're in a phase three, you're going to go through all phases of the hyperwave, 4, 5, 6, and 7. If you're in a phase four, I've never seen a phase four affected in such a way that you don't go through a 5, 6, and a 7. And the only way you would do that is by going from a phase four to zero overnight, which is theoretical. It's never happened. In a phase two, which a lot of stocks and sectors and industries around the world are in right now, you've only got a 1 in 5 chance that it's going to make it into a phase three. So I would say that everything in a phase two of a hyperwave, when a bear market started in indexes, is going to fail. But that's already built into my numbers, my statistics about a phase two. Most of them are going to fail anyway, so therefore the large majority will fail in a bear market. And maybe that 85% will go up to 100%. Probably not, but maybe it will. So that's my answer to that. Now, thank you for all the questions. Thank you for listening. Just a brief advertisement. Thank you all who attended and could not get into our last webinar. We only could take 100 people. We filled it up much faster than we thought. In the last 2 days, we were able to expand that, and another 75 people were let in, but still it was too late in the game. So we've increased that greatly. Nobody's going to have a problem on this next one. We've got plenty of room for everybody. This is more important to me as a webinar than the first one, and I thought the first one couldn't be more important other than talking about hyperwaves, which we're not going to do until January. But this one, because of when it is occurring 3 days before the election, with all these bear market signs that we just talked about in various sectors and various indexes, I'm glad we did Consensio when we did, because that allowed the people that got the details of that webinar to be able to apply them themselves without having to try to figure out what's going on. More importantly is this next one coming up. We're going to talk about closed-end funds like GBTC and the kind of action that it does. We're going to talk about ETFs, mutual funds, and how those portfolios, like the inverse portfolios that I just listed for you, which were all the ETFs, can be used in various ways in strong markets and weak markets, with the emphasis on weak markets because that's what we're in right now. If I'm right and we end up with this turning around and moving back up, you're going to want to know these things because you can move large amounts of money very quickly in very liquid markets and target the areas of the markets that Consensio is telling you are the places to be in or out of as other things are going on. So in terms of specificity, you're going to get a tremendous amount of information in a very short period of time. Now, Lee didn't want me to do this, but I'm going to do it anyway because I misspoke on Saturday when I said we're going to be able to bring the price of this down to $100. We are not. This is taking an enormous amount of work, more than the Consensio one, to put it together. And it'll be a full 3 hours with a full hour of questions after it. So we are going to ask for people that sign up, and I'll let Leah talk about signing up. A couple of things are going to be a little different, but we will be charging $150, which will be where we try to keep all of our webinars, which is about $50 an hour for a very intensive educational webinar at a very timely time. So I just wanted to put all of that in, and I'll turn it over to Leah in terms of when exactly can people begin signing up for this?
Yesterday.
Oh, great.
Yeah, if you guys want to just send, same as last time, in about a month, everything will be more streamlined. But as of now, yeah, it's still a little bit janky, but go to the website, lucidfunds.com. If you fill out the little contact form, it will go pretty much straight to me. Well, it will go exactly straight to me, and then I will email you guys back, provide a full description about what it's about, how to pay, all that good stuff. Obviously, you can pay in Bitcoin, and obviously, we prefer that. But so anyways, have an amazing day. That's all she wrote, or he, or they, or yes, or, but yes, we have full space, so everybody write in, please join. Very soon on the website, I'll have a full page that has the full description as well, but just use the contact form, and everybody have a great day.
Great, thank you all. Bye-bye.